Financial types everywhere are talking about a new book by Michael Lewis, Flash Boys, which exposes something called high-frequency trading. I'm Jack Otter, editor of BARRON'S.com. I'm here with Brendan Conway, who writes our Focus on Funds blog. So, Brendan, as financial journalists, we have to acknowledge what's going on here. There was a great FedEx ad where everyone's sitting around the conference table and this guy offers an idea, and everyone ignores it. And then the boss offers the exact same idea, and everyone says, oh, that's great, that's fantastic. And the poor original guy is saying, wait, I just said that. And I think half the financial journalists in the country feel this way after Michael Lewis has made this huge splash with a story that we've been reporting for, 5, 6, 7 years? Scott Patterson of the Journal wrote an entire book on it and so forth. That said, I got to give Michael Lewis credit because he tells the story better than anyone, and he's done a good job at bringing this to broad attention. So first of all, can you just explain what is high-frequency trading? Why do people worry about it?
So, Jack, I would argue that this is actually an old problem. It's just a new twist on it. What it is in plain English is it is a type of trading that's driven by computers that in some cases tries to sniff out large orders as they're coming onto the market and move in front of them. It's basically front running in the eyes of its critics. Now, the part that is new, I would argue, is that the technology has gotten so much better, and that the kinds of people that these traders, prey on, because it is a form of preying activity, have not kept up the pace in terms of the technology. So
the argument here is that the little guy is getting screwed once again. The market is rigged, as Michael Lewis put it. Do you agree with that?
Jack, I would actually argue that the little guy is not always in trouble here. This is chiefly a problem for big institutional investors trying to move large amounts of money, because that's where, if you can just make a tiny profit from ahead of each trade, that's where the money is to be made. I don't think that the small investor is really at risk here. And one way that you can see that is, let's just take an S&P 500 index fund. If there was money to be made there front running, what the Spider, SPY ETF was doing, how can it track the index so closely? I'm just skeptical.
So in other words, the Spider and those others, the return you get is actually extraordinarily close to what the index would give you even without fees or expenses.
Yeah, that's why I think it's less of an issue for the small-time investor. For pensions, for hedge funds, whoever else, different story.
Now, some small-time people do have an investment, a little share of a pension, of course, and you point out an interesting study that shows there's a little friction here that could hurt slightly.
Yeah, so when you actually try to quantify this, it was found recently that basically when HFT activity increases, if someone's trying to trade $20 million, the frictional costs, this person estimated, is probably about $10,000 a day. Doesn't sound like much, but I think it's a lot like if you commute for a living to your job, but you have to go back and forth through a toll over and over and over again. Over time, that's going to add up to significant cost.
The toll is an excellent analogy, because much of what, unfortunately, the financial industry does is not enable capital to flow more efficiently. It's a little bit of friction, just taking a little bit off the top, just like the house in Vegas, and that adds up to, obviously, enormous sums of money.
Yeah.
So how can the individual investor protect himself, with the caveat that it's not killing him, but still, you don't like this idea of friction, so what do you do?
Jack, the first thing is don't trade any more than you need to. I've long argued that one of the only powers that the small-time investor has is to just sit on his hands. You don't have a board to report to. You don't need to be moving in and out of positions. It's that kind of frictional activity which costs you in a number of different ways, and this is just one of them. So that's key.
And study after study shows that trading actually doesn't help you anyway. It's probably a loser's game.
Yeah, it's for your own psychic benefit, your entertainment. That's it.
Now, also simply, we always talk about this, but once again, owning an index fund is a good way. They don't trade very often, so if you owned a huge Fidelity actively managed fund, they might be trading those big blocks that could be front run. That's not really happening in the total market index fund.
No, and I think that if it was, we would see it show up in the index return. So again, those simple funds that don't trade much are going to minimize the exposure to this.
And finally, there are a few steps that have been proposed. One, Michael Lewis points out an an exchange that actually makes it allegedly impossible to do this high-frequency trading and therefore really to benefit from the high-frequency trading. Jack Bogle has a proposal to levy a very small tax on each trade, say a quarter cent or a penny. Wouldn't hurt those of us who don't trade very often, but it would really just take all the profits out of high-frequency trading.
Yeah, and all that is out of the reach of the small-time investor. The thing that is in your reach, use a limit order. Set the price at which you're willing to buy or sell, and that's it.
Great advice. Thanks very much, Brendan.
Okay, Jack.